Hello, clients and friends of MBP Sterling Partners. It's Jamie, and I'm back with another video series. This time, we're going to have a quick recap of the year that was 2025 and an outlook for the trends of 2026 in the investing world. Let's jump in. Well, the 2025 themes were somewhat crazy. It was a very loud year in the news cycle, but all in all, a positive returns year, despite all the political volatility. You'll recall we had the tariff tantrum back in March and April. We had more talk about the index concentration with the big Mega 7, Mega 8, Mega 10, however many you want to include in that large cap, mega cap series that were dominating the markets. We had diversification mattering again. You can see here the chart of the world. The TSX and the S&P 500 shows that for the first time in many, many years, the rest of the world did better than the S&P 500, and that's potentially a trend that's going to continue. We'll talk about that later. We also saw a US dollar decline. That was the first time for that in a while, and central banks worldwide started to cut their rates. So despite all that, we saw a lot of economic resilience, and that showed up in the stock markets as well. So how did we finish? Green across the board. Stocks, bonds were all up worldwide, every market. The sector returns you can see here from the TSX and the US sector. We had almost no losers. Poor little home builders over there in the US had a weak year. One of the themes that we often revisit is the mega cap divergence and how much those mega cap stocks are driving the returns, particularly of the US market. As we've noted before, this is not a phenomenon in Canada, and there's no real trend or pattern. But as far as the US goes, it's very important. Well, we saw that weaken in 2025. The cap weighted S&P 500, meaning the S&P that gives a higher weight to the bigger companies, did return a 6.5% more than the equal weighted. We will notice that the equal weighted still did a double-digit return, so that's a healthy return for the year. But also interesting is that only two of the original Magnificent Seven companies beat the S&P 500's 18% return. So we did see a little bit more diversification. The weightings of the top 10 holdings in the S&P, it reached a new high. So we're not necessarily predicting what that means, but we have noted that generally when we've seen these high concentrations, it hasn't been good things for markets in the future. The TSX had a phenomenal year. I don't even know how else to put it. It was supported by great operating earnings, so there shouldn't be a whole lot of skepticism to this rally. The earnings have been good, and the stocks have rallied as a result of that. For the Canadian dollar, it felt like the Canadian dollar had a strong year. It was up against the US dollar after many years of declines, but really that was a US dollar story and potentially a yen story. You can see here the green and the purple lines are the Canadian dollar rising versus the US dollar and the yen, but of course the orange line is a decline versus the euro, and actually the CAD declined versus many other global currencies as well. Central banks are largely in cutting mode, but you can see here in the pie chart that most are either neutral or cutting. The Federal Reserve and the Bank of Canada have recently joined that neutral stance. So we feel that the rate cutting cycle is largely over here. There will be a lot of noise about that in 2026 with a new Federal Reserve chair coming in, and of course, a lot of political pressure on the Fed to cut rates some more. Let's have a look at our 2026 outlook investment themes. Well, policy volatility, sadly, we think that's going to continue. It's a US midterm election year. That generally means a lot of fireworks in the news. Will that translate to markets? Yeah, generally it does in the short term, but as we've generally counseled people, do your best to ignore political volatility. It doesn't mean a whole lot for the markets. And yes, I will argue with you on that side of the argument this year, continuing even though it is the loudest and potentially the most market influencing administration that we've seen in our lifetime. Interest rate, the cuts are done. Long-term rates, we'll have a look at that chart later. They never dropped. Long-term rates kept rising. Does that mean there's potential for inflation to reemerge? That's something that we're going to watch closely. But important to note that the long-term rates, 5 years in Canada and 30 years in the US, are those that set consumer borrowing, or most importantly, mortgage rates. So even if the central banks are cutting, that doesn't have the same transmission effect to the economy if long-term rates don't fall alongside those short-term rates. Tariffs, immigration, and fiscal deregulation. We think that's going to continue through the year. That noise doesn't seem to want to go anywhere. So there could potentially be a lot of policies from this administration that are either positive or negative economically, but we'll watch for those as they come out. In terms of country focus, global diversification really paid off last year, paid off very well, in particular for Canadians. We think that trend is going to continue. It's been up until last year, 15 years of US market dominance. And that is a trend that historically has reversed, even though there's been long periods of outperformance. But we believe that the global diversification trend is going to continue. So we encourage everyone to start to diversify globally. So some other specific investment themes. Can artificial intelligence continue? Yes, it can. It's still in the news. The investment cycle is still very much on. In fact, we're cheating a little by listening to earnings cycle that's happening right now as we record in the end of January. But what we've noticed is that the capital expenditures on AI infrastructure in particular is continuing at record pace. That's very important for the economy, very important for a lot of corporate earnings. So we think that that can continue for now. At some point, we believe, as it has happened with every other technology cycle in history, that will get overinvested. We just do not know where that point will be. So sections of AI infrastructure, we note it's hard to justify the spend that's going on now in terms of potential future return from those spends. So we're starting to get into some pretty rarefied air up there in terms of the cycle in sectors of AI. Commodities, outside of oil, commodities have been very strong. We know that gold has been running a lot, so that could be a trend that continues. Those commodity cycles typically are longer lived than a year and a half. So it would be very common for a commodity cycle to continue. The big question is whether energy, and specifically oil and gas, will jump into that race, because right now those are not participating at all. In fact, they're both pretty cheap in the grand scheme of things, and the demand for oil has been somewhat lackluster. Nation building and infrastructure and manufacturing spending. We think that's going to accelerate. All the governments are spending on this type of nation building exercise. So we think that's a trend that is going to continue until the governments run out of firepower in order to build that. And then what we should likely see is more policies that encourage the private sector to continue on that spending path. So reshoring, nearshoring, all these names of bringing manufacturing back to home countries and less reliance on global trade, we think is a trend that is going to persist. Part of that is what we call catch-up defense spending. The world has largely relied on a couple of superpowers in the defense world, and we're seeing a lot of that spending being reversed, and some of those governments are starting to increase their deficit spending, in particular on defense as well. Politically, what's the outlook for 2026? Well, it's the US midterms. We're going to start talking about it shortly, and that's going to be all that's in the political news cycle until those elections happen. Right now, Polymarket, which is the predictions market that has exploded online, is currently predicting a Democratic win, and a resounding Democratic win. So we've seen that change awfully fast. And you'll recall the Canadian election last year. It also had Conservatives leading with a resounding majority early on, and that changed really quickly. There were some pretty extenuating circumstances in that election, but that's the way it went down. So if the Democrats win, well, then we just get even more policy volatility. Will we see impeachment hearings? Will we see President Trump just do more executive orders and avoid Congress and avoid having to go to vote in a House that he no longer controls? So here we can see, courtesy of BCA Research, they do some analysis on overall policy volatility and how that's affecting the world. And you can see, without getting into the weeds of these charts, everything is up and to the right, meaning their expectations of future and current policy volatility is all on the rise. But what about the strategists? Well, we should largely ignore them. The strategists are very average this year. The average projection of 74.59 on the S&P 500 is exactly 9% higher, which happens to be the long run 100-year plus range average return for the S&P 500. So as a signal, this gives us absolutely nothing. We know that when the analysts in general are bullish and average up, that their forecasts mean nothing. Remember that returns are rarely average. 100 years between 1926 and 2026, the S&P 500 was 2 points around its average 10% return, only 6 years. So in those other 94 years, it was either above or below 12 or 8%. So really, it's important to understand that the average return is not made up by average years. And let's look at what can happen within a year on the bottom right here. The bars are showing the annual returns of the S&P 500, and the gray dots show the largest drawdown on the year. So despite some really big drawdowns, you can have some positive returns, and you can also have less negative returns than the worst drawdown. Notable was last year. Remember the March and April drawdown? That was a pretty deep cut, and the market ended up with quite a positive return. So that intra-year run was pretty extraordinary. As for rate expectations, we touched on this briefly. The cutting cycle is over. It's not just possible, but it is probable that this will change before the end of the year, and we will start talking about either hikes or further cuts. Now, I know that's a wishy-washy answer, but generally we don't stay in this Goldilocks world for very long. The economy will either run into a speed bump and necessitate some rate cuts, or we will start to see inflation pick up, and central banks will have to raise their rates in order to combat that inflation. As we noted earlier, and here's the chart to prove it, long bond yields were not responding to the rate cuts over the past year or so. So we would expect, this is actually what we're watching to see that inflation right now, because we see bond yields trending higher. Our tendency is to think that inflation is going to remain sticky. But it also could be that the bond market is starting to price in some caution around the amount of spending that these governments are doing. Will this index concentration become an issue? I'm recycling this chart from earlier on the top 10 holdings as a percentage of the total S&P 500. We can see that's at an all-time high. Historically, that has been negative. Now, we hate to say it's different this time, but things don't always play out the way that you seem, and we would have said last year as well, it was also at a historical high, and then it gave us another higher year. So in terms of the Magnificent Seven and their contributions to the annual returns, you can see that it's been huge, but it's also been big on the downside. So in bear markets, which we saw in 2022, the Magnificent Seven contributed a whole lot to the downside of that market. That's important to understand. What we've noticed in the past, and this is almost universally true, is that the sectors that lead the bull market are usually the worst hit in the subsequent bear market. So we have become cautious on this. And as you can see over the years in the bottom right chart here, the impact of the Magnificent Seven has actually been declining over time. So 65% of the contribution in 23, 59 in 2024, and 46 in 2025. That means the rest of the index and the rest of the big companies in the US anyway have been picking up their end of the slack and still delivering positive returns. There are reasons to be optimistic in 2026, so let's run through a few of them. Firstly, the bull market has been broadening. Earnings has been widespread amongst the S&P 500, and it's been getting better, especially over the last quarter, among more than just the Magnificent Seven that's driven the last few years. The AI adopters, while they're still posting good numbers, should be delivering efficiency tools that come into the rest of the S&P 500. So as the productivity gains from AI start to permeate throughout broader corporate America and corporate Canada, that will translate to better bottom lines. Two is neutral and easing monetary policy. So we've had easy money. There's no question. We saw most central banks cutting. That should deliver and continue to deliver some tailwinds to corporate America, and lower cost of capital and lower cost of borrowing generally means more spending and better profits. In Canada, we've got an equity valuation advantage. Now, we would argue that Canada should trade at a lower price earnings than the US, simply because there are better growth profiles in the US. But that valuation gap can provide a margin of safety if we get into declining markets. Number four is pro-growth policy and deregulation. We've been talked a lot about the US policy and how that is good for corporate America, but we're starting to see that in Canada as well. The talk from the Prime Minister's office has been for taking down trade barriers between provinces, investing more in Canada. This is all good for Canadian companies, and we expect that will be a tailwind in 2026. And we mentioned before, but a robust profit growth, and lately even seen more for small cap indexes, which typically have more volatile earnings streams. Canadian consumer has remained resilient in 2026. We expect the growth to reaccelerate, even though the 2025 trade disputes had a lot of people lagging on their wallets. That should get better in 2026, even if we've started off a little bit rocky. And finally, the Canadian government has announced a lot of investing or spending, depending on which way you want to look at it. But those investments will find their way into corporate profits and into consumers' pockets. What is there to be pessimistic about in 2026? I almost feel like we don't need to read this slide. These are conversations that we have often amongst ourselves and with our clients. But here's a list of a few items to keep on the radar. Firstly, earnings expectations are pretty lofty. Analysts like to carry forward past earnings into future growth. And at the moment, what they're calling for is on the high end of historic growth rates year over year. So that could come to an end as the cycle comes to an end and have valuations adjust accordingly. The midterm election year volatility, we touched on that already. Sticky inflation and higher for longer fears on interest rates. We'll throw in that the perceived lack of Fed independence. That's another political news story that really is relevant to financial markets. So we're watching that one closely. If there is a breakdown in the independence of the Federal Reserve and it becomes a puppet of the administration, that is negative for financial markets. It has been globally whenever it's happened. Canadian bank credit pressures and trade frictions between tariffs for Canada and establishing new trade routes. There's a lot of friction for Canadian trade. And on the banking side, that will corporately cause credit losses or at least credit stress. And in the household personal market, we're seeing increased credit stress among Canadian borrowers. A lot of mortgage renewals are coming this year, the biggest year ever in mortgage renewal history. And those mortgages are renewing from very low rates to what are now modestly higher rates. It used to be considerably higher rates, but now that 5-year mortgages are in and around 4 or sub 4%, that change has been mitigated quite a bit from a couple of years ago. Lastly, fiscal deficits and rising debt costs. These spending from these governments so far, the debt hawks have not come in and checked back governments, but the rate of spending is extraordinary. And it is a risk that at some point the bond market just says no mess and doesn't allow the governments to borrow more, at least at these favorable interest rates that they're currently borrowing at. Where does that leave us? Well, we always have to weigh the balances of the positive and the negative. Right now, we are admittedly late stage cycle, meaning that we've had several good years in a row, and it is normal to expect that there is a bad year coming somewhere along the line. At the moment, we've had 3 trailing years in the positives, and the trailing average return over those 3 years is north of 20% for the S&P 500. When that happens, as we've done some analysis here, the probability of a negative year following rises from 14 to 26%. So that's still not a huge probability of a negative year, but statistically speaking, we are getting closer to a negative year than if we were earlier in the cycle. Now, that's the late stage cycle negative. The positive is that earnings are robust, and we talked about this already, but this is the graphical version of this. We can see that earnings in the orange bars have been steady, but steady rising quarter over quarter, not volatile at all. And year over year, we've seen a similar pattern where these earnings have gotten considerably better.
You can see here in past cycles, it's a low volatility earnings environment, which is nice and predictable, and that allows stocks to trade at higher valuations.
That's it for our outlook this year. Would love to talk to you more about it or how that affects your personal portfolio. So please give us a call or arrange for a meeting with us. Uh, as we did last year, I like to end off with some cool tools, but I'm just going to cheat and use the same one as we did last year. Last year, we asked you, are you still using Google to search? Well, maybe you're using Gemini right now. But I will ask you, can you guess which parts of this presentation were created with AI tools? We're using them more and more. They're a great productivity tool. They still need to be double checked because they don't always give you the right answer, but but we're finding it very useful. Another great tool that we've discovered this year, if you do a lot of traveling and spend money in a lot of different currencies, check out Wise. This is not an advertisement. We are not being sponsored. It's just a great, easy to use money tool. It sends you a payment card that you can use any country in the world in any currency. So give us a ring and ask about it if you'd like to learn more. Thanks for tuning in, everybody. We look forward to talking to you next time.